All right, guys, welcome back here to the 13th grade. This video is actually meant to be just kind of a bonus section for the investing in taxes. I want to go over a couple of just kind of real quick concepts. If you have not watched the full part that we did as far as the financial literacy investing in taxes, I really think you should go back and kind of watch that first before you watch sort of this extra content, because I think it's going to be a little bit more useful for you. There are two concepts, and you may have actually heard of these before, but I want to make sure that you do understand two specific concepts that really can make people extremely frustrated. We are not going to specifically dive into these particular options as it relates to building wealth, but I want you to know that they exist. So, meaning this is not necessarily a tool that I use. Ultimately, this is a tool usually people that are, ultra wealthy use. Think of people that are making, let's call it 50 million and above net worth, maybe 100 million above net worth. It starts to come into play. It can start to come into play in a small sense, which we'll get into. But again, this is most for people that are going to be way outside where you're going to be if you're just kind of watching this video, maybe potentially where you'll be in, 10 years from now or 20 years from now or whatever. So the first one is a concept in the idea is that debt is not income. And so that this might seem completely obvious to people, but as it relates to taxes, remember, how exactly are we taxed or what are we taxed on? For the most of us, our regular 9 to 5 job, we understand that we are actually taxed on just, sort of a W-2 income, right? And so we go in, we work, 40 hours a week, whatever it is, we earn a certain amount, let's call it $20 an hour. Let's say we work 40 hours a week. That's going to be 800 bucks, for the week. And then we are taxed based on that, based on the marginal tax rate that we went over, a couple of videos ago. Because that is income, we're taxed on it. So we got to pay the federal income tax. We have to pay Social Security, Medicaid, all that, all those types of things, right? As a business owner, if you're making money and then, obviously you have expenses, we talked about, there's write-offs and things. Whatever the net income is there, you're actually pay, a certain particular amount of taxes, and that varies. And then if you are investing in stocks or you're doing something else, so you're investing money after it's already been taxed. So for example, you've gone to work, again, you worked the 40 hours a week, you made $800, you're taxed. Let's say you have, $700 left over. You take that $700 and let's say you put it into the stock market, you buy Tesla and Tesla goes up and now instead of $700, you have $1,400. That $1,400 is, a portion of that is profit. It cost you $700 to purchase it. It's now worth 1,400. You have a $700 in profit. When you sell that stock, you are going to have a capital gains, or you've created income that's going to be taxed based on the capital gains rate. Now, that's all important. When I say to you that debt is not income, for most people, you're probably thinking to yourself, like, yeah, obviously debt's not income. Like if I go, have a credit card, for example, and I swipe my credit card, you technically you have the ability to purchase something, but that ability to purchase something isn't necessarily income, right? And so if I went and I got, say, an auto loan, for example, so I go to my bank, I need a $25,000 loan. I go into the bank and I say, hey, I need a $25,000 loan. Here's my credit. Here's my income. They write me a check for 25,000, even though I now have more money in my pocket because that is a loan, or it's debt. It's not necessarily income. And again, you might be thinking to yourself, yeah, obviously that makes a lot of sense. Now, the reason why this is important, okay, the reason why I'm going over this is because what some people will do, the ultra wealthy, is they use debt as an income source. Okay, so hopefully that makes sense to you. So here's an example. Let's say I have over time, I'm putting money into, an IRA or no, not an IRA, 401k. I'm putting money into a taxable brokerage account. And let's say just instead of a couple $100 a month or something, I'm putting a tremendous amount in that. Or let's say that I work for a company, and that company necessarily is giving me a bunch of stock or something like that, right? I have a bunch of income, from that particular source. Let's say that I have a rental property, right? And that rental property goes up in value, and I have $600,000 in equity. I can go and take that equity out just like if I worked, and I can use that money to then go purchase something. Okay. The reason why this is a very powerful tool, and the reason why I'm covering it here, is because oftentimes we think about creating generational wealth, okay, is this idea of, or creating income or creating wealth in general or whatever, is about you're working, you generate income, through a W-2, you're taxed on that, and then that particular income is then deployed into some particular asset or an investment that then earns a return on investment, and then that return on investment, you have income. However, debt can be a very powerful tool when used like income. I'm trying to explain this the best way I can. When used like income, in the example of I buy a real estate property for 200,000, I take the 200,000, and over a course of, let's say, 10, 15 years, that property is now worth 400,000. I go to the bank, I take out a home equity line, so I refinance that particular property. I take out the 200,000 in equity because it's now the house is appreciated, it's worth more. I refinance it, I take the equity out of that particular property. I now have a check of 200,000. That check of 200,000 is debt because it actually came from the bank, right? It's actually something I have to pay back over time. However, if I take that $200,000 and let's say I break it up into two $100,000, I can go then buy two rental properties, assuming $100,000 down gets me into two more rental properties. So I'm using the debt, not my income, the debt to go and create and to purchase more assets. All right. And again, it's important because if you were to follow, let's say, the Dave Ramsey method, where you're never taking out any debt, what that means, and we're actually going to go to this concept next, but what that means is every single dollar that you make, especially if you're doing well off, some portion of that, let's say I make $100, some portion of that is going to go to the federal government. I'm paying taxes on it, and then I only get to use what's left over. So instead of thinking about that as I went and made income, think about that as my net worth has increased. Okay. So I'm starting at zero. My net worth has increased. If it's increased through labor, through income, I have to pay taxes on that. And so I only get a portion of that. That is less effective than if I'm starting at zero and my net increases because it's equity in a property. And then instead of selling that property, instead of selling it and then having income, because if I sold the property and I netted the 200,000, now it's income because I sold the property and no longer have it. If I go and take debt out, I now have the same $200,000, but it's not income. It's not tax because it's debt. However, I can still use that particular money just like it was if it was income. So, yeah, hopefully that makes sense. It's a very, very powerful tool because if you go based on the taste of the Dave Ramsey method, you basically have to work whatever your tax bracket is more, like 20% more, 30% more, whatever, because you're always having to pay some to the tax man. If you're buying assets and those assets are appreciating, all I can do is I can then take out that debt and then I can use that debt to go purchase something else. This is actually a very powerful tool when it actually comes to building businesses. Remember, we talked about a dumb business? Remember, a dumb business we talked about is the value of that dumb business is, or the business is generally what the revenue is, right? How much profit that the company is making. If I somehow get a business and let's say it's profitable at, I don't know, $100,000, and over time I'm able to create some efficiencies and I increase profit or whatever, I then can increase the value of that particular property, of that particular business. Instead of maybe making 100,000, maybe I'm making 300,000. Basically, the value of that particular business has now gone up threefold, right? And if I'm actually continuously increasing, the value of that business might even be more than threefold, might be fourfold, right? But in the idea that I wouldn't necessarily per se want to sell the business, right? Because if I sell the business, I have a taxable event because I'm now actually cashing in my equity. I no longer own it. Instead, I might go back to some sort of lending institution. I might say, hey, my business is doing really well. Here's the revenue. Here's the value of the business. Let me take a loan against the business. I pull out the cash of that business. I now have income that's tax free. It's not income, but I have money that's tax free. I'm not paying any kind of, I'm paying, again, it's debt, but I'm not paying any taxes on it. And then I can take that money and then I can deploy it. And so, why somebody might necessarily want to do that, and this is actually goes into a little bit about like why, how interest rates affect business and so forth. If I buy a rental property for 200,000 and it goes up over 10 years and it doubles, so now I have $2,000 in equity. If I sold that business, again, the $200,000 comes out, or I sold that property, the $200,000 comes out. I'm going to pay a capital gains on that. Let's say that's 15%. 15% of $200,000 is a nice chunk of money. Instead, I could take the $200,000 out, and let's say interest rates are reasonable. Interest rate, I might only have like a say 5% interest rate. Well, I could take out that 200,000. I could then pay the 5% the bank to actually have access to that money. But if I could take that money, let's say the 200,000, and I can deploy it into another vehicle that might get me 10% or 15% return on investment, well, while I'm paying five, I'm making 10. Hopefully that makes sense. And then again, those two things or whatever it is that I purchased with that 200,000, it's probably going to go up in value to some particular percentages. Remember we talked about how in when we put money into real estate, it's not just the what we invested that goes up in value because we have access to the entire property value goes up. So it's not again my like $60,000 going up in value, it's 300,000 going up in value. So if you don't remember, go back to that. Go back to that. So the idea there is I took out 200,000. I'm paying 5% on the 200,000 that I took out via the home equity line. Again, that's debt, so I'm not taxed on it. I deploy into two more properties. Those properties appreciate at say 3 to 5% a year, but then I get 6 to 8% cash flow a year. All of that is much more than the 5%. And so I'm building a tremendous amount of wealth and basically doing it tax free. So hopefully that makes sense. If not, it is something that you can reach out. If you're in our community, shoot me an email. Happy to jump on. We'll talk about this in other aspects as we go along. But again, just one concept that I think it is important that you understand because it, again, it is a powerful tool. Not necessarily something that you'll be using right away, but probably definitely something that you'll be using in the future as you sort of gain equity in property and as you decide instead of selling it, maybe just to pull out some of that equity and then deploy that money into other resources.